Now that you guys know how to crunch the numbers, you know what income is, you know what expenses are, and you understand a cap rate and an ROI at a fundamental level, let's talk some good news and some bad news. Bad news first because it's quick. The bad news is the real estate market's really hot right now. It's at an all-time high, and that means rental properties make less money than they did back in 2012 when the market was at an all-time low. Duh, right? But they're still worth it. They're still a strongly performing investment because rental properties make money in a variety of ways. That's the good news. Your rental property makes money in 5 ways. It's really 4 ways, and I threw in the bonus of rent growth. And we're going to talk about those 5 different ways your rental property makes money in this next lesson so that you understand what you're kind of looking for when you evaluate each property. And the benefit to this is you got some diversification. You know, if your property doesn't have a strong cash flow year, at least it appreciated a little bit, right? If your property didn't appreciate, at least it cash flowed. If it did neither of those, your tenant still paid off your mortgage, right? That's what principal production is. They're paying off your mortgage balance for you. And if you got none of those things, you just made a little bit of money, well, hell, at least you got some tax write-offs out of it through depreciation, right? So these different vehicles of generating income through rental property, they offset each other, but they also amplify each other too, right? So if you have a bad year of cash flow, you might have a good appreciation year, or at least you paid off your debt, or you could have a good cash flow year and a good appreciation year, and your debt got paid off, and you got some good tax write-offs out of it, and the rents went up. So when you have a strong year, you have a really, really strong outperforming property that could give you as high as 30, 40, 50% returns or more once you combine all these different things together. So let's talk about the first one, cash flow. Let's hop on over to our hypothetical fourplex in Kentucky that we think you guys would like very much, and our handy spreadsheet over here. Remember, our sale price is $325. Here's our income. Here are our expenses, taxes, insurance, utilities, management, vacancy, maintenance, all that good stuff. And here's our results. It's the same cap rate as the previous lesson and the same return on investment as the previous lesson. So cash flow is your total rents, all your income, minus all of your expenses, your operating expenses, minus your mortgage payment, principal and interest, right? The portion that goes to paying off the balance, and then the portion that goes to paying the bank their fee for letting you borrow the money. That mortgage payment, it combines both of them together. So once you subtract this from your net operating income, you get your monthly net cash flow. In this case, it's $301 a month, right? It's $3,600 a year, and it's a 5.56% return on investment. That's decent. If the property is actually giving you that every year and it's giving you some money to improve it and deal with the vacancy, and it's predictable to start and rents are going to grow over time, we'll talk about how that works soon, then it's an all right start. All right, a lot of people want double-digit returns. They want double-digit cash flow. That's tough in this market. This still beats a lot of the dividends, basically the cash flow you're paid by stocks. If you're purchasing dividend stocks, most of those don't have a 5.6% return for a quality stock. That's usually a pretty risky, quote-unquote, stock that gives you that kind of cash flow every year. So this is a reasonable amount of money. But when you consider the fact that you have to put $65,000 down in one chunk to get into this. The entry point's high, right? And you have to take on a loan of $260 that you're obligated to pay every month for 25 years. And you're going to add this to your balance sheet, right? Your financial statement. It's going to affect your ability to get future loans. Then you look at this cash flow of $300 a month, and you look at this, whole 4,000 square feet of fourplex that you got, and the 4 tenants that you have to think about when your management company reaches out to you, and you go, man, is that really worth it? Is it really worth it to own this property just to make this little bit of money? And my answer to you is yes. And the answer is yes because of all these other ways that you're going to make money on your rental property. So let's talk about appreciation a little bit. Appreciation is pretty cool. When it's good, and when it's bad, it's not that great, right? But properties don't depreciate on average over time. On average, real estate has been known to appreciate about 3 to 5% per year. Depends on the market, right? And your timing when you bought it and all that good stuff. So let's plug in 3.5% appreciation on this property and see how this works. So you bought this property for, where's our number? $325,000. And let's say it goes up 3.5% per year. That means your property appreciated 11,375 year 1, And then in year 2, remember it's worth 336 at the end of year 1 now, right? In year 2, it's going to appreciate another 3.5%, but not 3.5% of 325. It's going to appreciate another 3.5% on top of that 336 that it's now worth, right? Because this is compound interest. So it's going to go up to 348. It's 11,773. So on average, if appreciation were about 3.5% a year, then your property is going to go up more with every year that you own it. Your appreciation gain is actually greater every year that you own it. That's how compound interest works. At the end of 5 years, if this property consistently appreciates a modest 3.5% per year, then it's going to be worth $385,998.05. That's a good bit, right? That's another $60,000 total. If you total this up, you can see this sum in this bottom right corner. $61,000 total appreciation in 5 years on top of your cash flow that you've got. Why is appreciation so great? People get so amped up on it. It's because it has a different impact on your returns with a loan versus without a loan. Why? Because you bought this property for $325, but you only paid for 20% of it up front. Your investment was $65,000. The bank paid for 80% of it, $260K. And you're paying them back with your tenant's money, but your bank paid for 80% of this. But you don't have to split the appreciation 80-20. You keep all the appreciation on that 325 value. So really the return from this appreciation is 11,375 divided by your down payment of $65,000, and that's a 17.5% return on investment in year 1 alone. 18.1 in year 2, 18.7 in year 3, and so on and so forth. It just gets better and better and better over time, right? So appreciation in a leveraged circumstance, leverage means you have a loan on it, right, with some debt, amplifies. But it amplifies in both directions. Watch this. Let's say if the property goes down in value, there's a little bit of a correction in the market, right? Then you lose that amount of money every year too. And that's a negative 17% return. And that's why cash flow is important also, because maybe the rents keep increasing and you're collecting a little bit of money while you wait for the market to correct, go back to normal, regain its value. So appreciation can go both ways. Don't get too high on it in the absence of cash flow, because what happens is markets could get bad and you're still stuck with this loan payment. If your property doesn't cash flow enough to cover it, then you're gonna be really pissed off that you have a losing investment on the appreciation side that you're paying out of pocket to own, right? So I don't get too high on appreciation, but I do look for markets that have strong appreciation prospects, and we'll show you how to do that a little bit later. The next way you make money on your rental property, this is pretty cool. It's called principal reduction. That's a fancy way of saying your tenants are paying off your mortgage for you. When your tenants pay off your mortgage for you, let's say you have a 25-year loan, like you do on this particular property, at a 4% interest rate, and the total loan amount is $260. Well, once you get to the end of 25 years, tenants have paid off this $260. You no longer owe it. You owe $0 on the property. When you first bought the property, you have $65,000 down on it, right? It's worth $325. If you sold it the day after you bought it, you put $65 back in your pocket. If you sold it 25 years after you bought it, and let's say it didn't appreciate at all, let's say it's still worth $325 after 25 years, unlikely scenario, right? But if you sell it 25 years after you bought it and your tenants have paid off your mortgage, well, you're putting all $325 back in your pocket, right? So you made money from your tenants paying off your mortgage. Your equity increased in the property because this loan balance here shrunk. Ultimately, equity is just the property's value minus the debt obligations on it, right? The portion of it that you own, not the portion that the bank owns. It excludes that portion that the bank owns. So how do you figure out how principal reduction works and how much money it makes you every year instead of just at the end of all 25 years? Well, here's how you should think of it. This mortgage payment of $1,372.38 in this deal calculator, it includes principal and interest. It's split. Some of the money that you're paying to the bank goes towards reducing the balance of this loan, actually paying off the loan, and some of it goes towards paying the bank a fee, the interest rate, that you owe to them because they allowed you to borrow $260,000, right? And that money is not split 50-50. It's actually divided up using something called an amortization schedule. So Let's take a look at how an amortization schedule works. Let's plug in, and I just grabbed an amortization calculator off of Google, which we have built into the spreadsheet, but this one will demonstrate how it works over a full 25 years. You have a $260K loan, it's a 25-year term, and it's a 4% interest rate. You hit calculate, same monthly payment, right? $1,372.38. Yep, they match up. And you can click this show or hide amortization schedule button on a lot of these, and you'll see every single payment and how it divides between principal and interest. So you'll see the very first payment, which is a month after I'm making this video, right? March 2022 of $1,372.38. $505 goes towards your principal. That's profit, by the way. That's money that you've earned. It goes towards paying off the loan. $866 goes towards interest, right? And then you can see every month that principal amount goes up a little bit more and the interest amount goes down a little bit more. Why does it work like that? Because this balance, the interest is charged on the current running balance, and every month that balance goes down a little bit. So the interest payment goes down a little bit with it, because 4% interest split over 12 months on this balance is lower than it is on this one, right? Hope you're following. Towards the end, right when you're about to pay off your mortgage at the end of those 25 years, the interest is very low. Let's take a look at, let's say 2043, 50 grand left on it, right? November 2043, you owe 50,000 left on this loan. The interest is only 171 because that interest rate on a 50K balance means you owe much less interest on that payment. So more of your payment goes towards that principal balance. What does this mean for you? That means the longer you own this property, the more money you make from the tenants paying off your mortgage. And I've got the first 5 years broken down in this deal calculator. You can see that your total principal payoff in year one is $61,8101. And you can see the total interest paid is $10,287.50, right? So this total mortgage of $1,372 times 12 months, well, it breaks down in $61,81 of principal reduction, $10,287.50. This portion is expense, right? This is not money you're making. It's an expense, you write it off, all that stuff. This portion right here is profit, right? It's just profit you don't get to put in your pocket because it goes towards paying down that loan. The loan is now $6,000 smaller after the end of year one. And $6,000, $61,8101 divided by $65,000, your down payment, your initial investment, that's a 9.5% return on investment. That by itself is equal to the S&P 500's returns. Now, it's not a compounding investment, right? And I'm not even gonna go into explaining that. But you're getting almost a double-digit return at a 4% interest rate your very first year of owning the property. And by year three, you are getting double-digit returns every single year thereafter, just from the tenants paying off your mortgage. That's if you make no net cash flow. You spent all the money that you got in your pocket on repairs and vacancies, and if your property didn't appreciate, you still make this much a year just from paying off your mortgage. That makes a cash flowing, stable rental property a pretty safe investment, right? And the best thing about this cash flow that you make, this income that you make, this 3611 plus this 6181, you're probably not paying taxes on it or not on much of it, and that's because of depreciation. So what is depreciation on your rental property? Well, I'll make it simple without making this a tax lesson. The IRS looks at this property right here and they go, man, this thing's got a lifespan. Structure has a lifespan, not the land. The land has an infinite lifespan, right? But the components of this property do have a lifespan. And they go, hey, for a residential property, it's got a lifespan of 27.5 years. That's the IRS defined lifespan for a residential rental property. You can only depreciate investment properties, not the home that you live in, but your investment property has a 27.5 year lifespan. That means you can evenly write off its value, the structure's value, over 27.5 years, right? Assuming that it's losing that value. And if it's not losing that value, you could still do it. I'll tell you more about that in a bit. What does that equate to? Well, look, not all this 325 is structure. Some of it's land value, right? So what you've got to do is you've got to separate the land value of the property from the actual structure's value. Now what you could do is you can go to tax records and you can see what the improved value is versus the land value. Your county's going to have an assessment Or you could look at other pieces of land nearby, what they're worth, and chalk up some percent of the value to it. Or you could just go 80-20. The IRS tends to say, hey, 80-20 or something reasonable, right? 80% of it's the structure, 20% of it's the land. If I can justify that the land is worth less and the structure is worth more, you get a bigger write-off, right? So maybe you go 85% on that. And that means that 85% of this 325 is your depreciable basis, right? It's the value of the structure. You could take that number, that 85% of 325, and let's for good measure just do a quick calculation here. Oh, I should have done times 325. 85% of 325, 276, right? So your property, the structure is worth about 276 in this scenario. The land's worth the remaining 49 or something like that. That 276 could be divided evenly over 27.5 years. Check out this little equation over here, right? So the IRS would let you take about 3.6% of this property's value every year and deduct it from your income. Remember, the income is 3611 minus 6181. You could subtract $10,045 if you tell your accountant to do it every year from your net income. So what was your net income? It was 3611.49 plus 6181. That's 9792. And you could subtract 10,045 from that net income, and so you don't have to pay taxes on any of this profit earned. What's that worth? Well, if your tax rate is, let's say you're a high earner in California, right? You pay 50% tax rate. Well, you write off $10,045 from your total income, and you'll save about 50% of that in taxes, right? You'll save about half of that in taxes. So you're saving $5,000. Your profits are going to be about $5,000 from the tax write-off because you're not getting taxed on $10,000 of income. I know that's a little bit ambiguous, right? That's kind of like a unrealized gain because you're not making $5,000, but you sure are saving $5,000. You're not paying to the tax man at the end of the year on this $10,000 of income that you would have had to pay taxes on before, but you're going to deduct thanks to depreciation. It's very important to tell your accountant to do this for you, and it's important to understand that when you go to sell a property, depreciation is recaptured. Basically, you're paying this write-off back if the property didn't actually lose value. If you don't want to pay it back, you could do a 1031 exchange. If you don't want to pay it back, you can refinance the property and just keep it. And we'll go into some of those strategies a little bit later, but just know that the tax benefits are worth something here. So you're making money in 4 different ways with this property, plus rent growth makes it that much better. And we'll talk about